Hey everybody, Brian Shannon here from alphatrends.net. Today is Friday. It's the 19th of February 2016. Hopefully you had a decent week here. Equities continued their bounce back that began late last week, and the S&P 500 up close to 6%, 3% rather. I'm sorry. I was looking ahead at the semiconductors, which were up close to 6%. But indexes of the equities were up across the board. Bonds sold off only slightly, but we're still down month to date, and we're still down year to date. It's still my belief that we're in a bear market and we're experiencing a bounce, but there are some little clues here that maybe this market has a little bit further to bounce that we'll talk about here in a moment. The main thing, though, is we are still below a declining 50-day moving average. So that tells us that rallies are guilty till proven innocent on the bigger picture. So when we have that declining 50-day moving average, we're highly suspect of rally attempts. Now, when we back it up to a weekly time frame in particular, we of course have this bigger distribution that appears to be undergoing, and we've had a lot of support found in this area. We've bounced from here numerous times, and we're continuing that bounce from that level down near 180. And when we look at let's start with a 60-minute chart here, and we'll put the year-to-date volume weighted average price on there. And what we saw this week is that we not only got back above that year-to-date volume weighted average price, that's the purple line right here, but we held above it, and we actually came down and tested it briefly here today on the open. So when we see that this widely measured, this measurement of the psychology since the beginning of the year, basically, as far as who's in control, we are above that. We're also above a rising 5-day moving average. So as I say, you don't want to fight the direction of the 5-day moving average. When the 5-day moving average is advancing, the intermediate term trend is considered innocent till proven guilty. It doesn't mean that you just get bullish all out, because of course we're still in a mess on the daily time frame. But for intermediate term trends, this kept you out of being short this week, which was not the right way to be, obviously, even if you think, well, it's just a bear market rally. If it's just a bear market rally, the market will tell us. The market will give us the clues that it will start to undergo some distribution and maybe do something like this in this area and then break support. And when that 5-day moving average is flat to declining and it breaks back below 190, then it looks to me like we're back on to sellers in control. Meanwhile, if this 5-day moving average and in more particular, the volume weighted average price year to date down at 190 continues to hold as support, then we have the possibility that this market could be able to sustain some further upside. The one issue, though, the one glaring issue is that we have this prior resistance area, and we're up against that. So you can't just get outright bullish on this market. It's irresponsible to get bullish on this market. One possible scenario, if you're looking to be, for the bullish justification, which isn't, you don't want to justify a position, but this could be a left shoulder, this be the head, and maybe we come down and create a right shoulder. The 50-day moving average flattens out. Now that's going to take a couple of weeks to materialize, so I don't want to get too far ahead of ourselves here. For now, going into next week, we have the buyers in control of the intermediate term trend. We're above a rising 5-day moving average. And I think as long as we hold above probably 190 initially, that's where we continue to give the benefit of the doubt to the buyers. But if we start breaking down and we hold below a 5-day moving average, so if the 5-day moving average does something like this and we hold below it, it's time to become bearish once again on the intermediate term time frame. The Nasdaq bounced, as we mentioned as well. It's still below the declining 50-day moving average. I had drawn this in for a previous video for subscribers that we wanted to see this level hold as support. We came right down to it today and held above it, and we're also just kind of fighting that volume weighted average price year to date. So that begins right here, and it averages the price times the volume over the entire period of time, and you can see we're pretty much right at it at this moment. So I think as long as we're above about 100, let's just say, then we give the benefit of the doubt to the intermediate term trend for the buyers. And then if we fail, however, then what we would be looking for is that we would be looking for a short scenario, something that looks like this, that holds underneath a 5-day moving average and then declines further. The Russell 2000, this market held right at it, right below actually its volume weighted average price year to date. And again, we're down year to date, but the average price paid in the Russell 2000 is just overhead. We've got a rising 5-day moving average. All together, you look at these markets, we have conflicting messages across various time frames. We're in downtrends on the longer term time frames. There's no denying that. We're intermediate term, we're in an uptrend, and we're finding that we're at a level that has been important as far as resistance and is starting to show that, perhaps it is once again. We can draw trend lines that look like this and show that this has kind of been a band of resistance. And, trend lines are to be drawn, as I learned from Larry McMillan, with a crayon, not with a sharp edge and a pencil. It's an area, and here we can see that this band of downward sloping resistance is exerting itself right now. Perhaps we can turn this thing around, but it's still guilty till proven innocent on the longer term time frames. Let's talk about oil just for a quick moment, because this market, the oil market is still in a downtrend as well. Yeah, we still have a very distinct pattern here of lower highs and lower lows, and people get excited about big volume events and then a little bit of a rally, and perhaps that was an intermediate term low, but the trend in oil is still clearly lower. And as I like to point out the phrase, if they don't scare you out on the way down, they'll wear you out. Markets don't just turn on a dime typically and turn right back higher from downtrend to uptrend. Look at the markets over the last last year and a half. It took a while for the sellers rather, to gain control. Semiconductors are still in a primary downtrend on the weekly time frame, and on this you could even argue that here's a left shoulder, a big head, and a right shoulder. That's not the time frame that I'm interested in looking at, but it's something worth noting for the longer term time frame. Back to the daily time frame, where are we? Where have we come from? We've just come from 45, and where have we come to? We've come up to 50. So we've rallied about 10% off the lows in 6 days. So you ask yourself, where has it come from? It's exerted 10%, it's up 10%, and where does it have the potential to go before it's likely to encounter a source of supply that will act as resistance? That's where we are right now, and that's just below the downward sloping 50-day moving average. So the daily time frame, it looks like we should find resistance here. If we're to create a bullish environment, we would want to see it come down, create a higher low, and then that 50-day moving average flatten out, and then begin to see that it moves. So in other words, we're still guilty till proven innocent. We are above this rising 5-day moving average, and when you use multiple time frames, you've got to be able to differentiate what is the time frame that you in particular are trading on. I emphasize the intermediate term trend because that's what I trade on. If you are a longer term trader and you're looking at this and saying we're in a bear market, don't do the stupid thing and just sell short anytime it ticks higher. Wait for the evidence to say we're turning back lower once again. Once that 5-day moving average flattens out and then prices break below it and make lower highs and lower lows, there's plenty of time. You don't have to buy the bottom to make money on the way up. You don't have to sell the top to make money on the way down. And right now we're in an area that should act as some resistance, it looks like, but we don't want to sell short because we're still making higher highs and higher lows above a rising 5-day moving average. Biotechs, this group has been beaten up really badly here, as we know, on that weekly time frame. You look at what it's done this year, down, I think, still, what is this, 22%, 23% year to date. So it's still, the worst of the worst right now. And on the daily time frame, we still have a declining 10, 20, and 50-day moving average. So it's still guilty till proven innocent. So don't read too much into this next part, but a potential for an oversold bounce, I think, up towards that volume weighted average price year to date, and that's up near 275-ish. Let's look together here. It's about 276-ish. What we saw today was that the market pulled back to this prior important level. This had been support turned into resistance, support again, and then once again found buyers in that area today. That's also coincident with the rising 5-day moving average. So near term, the buyers are slowly gaining control, and it's possible that this market may be able to continue to bounce higher from here. So we look at a shorter term time frame. And you can see we bounced right from that 5-day moving average here today. And if it can continue to, maybe get back above this level next week with a stop under here, then perhaps the biotechs have the ability to bounce up towards that year-to-date volume-weighted average price, which again is found near about 276, and that might be a good risk-reward trade. But keep in mind, it's still a higher risk trade because we do not have trends aligned. We're looking for a bounce with an overall bear market. That is not the low risk trade. The lower risk trade is, when we find the trends aligned on the downside and sell short. Let's see what the market gives us and not put our thoughts into here's what the market has to do. Apple, we saw some bouncing here this week. It broke above that range that we've been talking about. And as I say, you don't want to buy just because it breaks above the high of this range. In fact, that's often a very uneducated place to buy. If we ask ourselves the questions, where has it come from? It just came from 92.5 to 97.5. So it rallied 5 points, a little more than 5%. So do you want to be the guy who buys up here on this so-called breakout after it's expended all that energy? Absolutely not. Let it go without you. Wait for it to pull back and see if it sets up into an area that makes sense for potential support. Right now, we're in that area that has the potential. It's the midpoint of that range that we've been talking about for the last several weeks, and it's also right at the rising 5-day moving average. So what would create a counter trend buy in Apple? Perhaps, so we're still in a downtrend, there's no doubt about that, and this rally here doesn't look any different than this rally right here does to me, or this little so-called breakout on that day. We're still below a declining 50-day moving average. If you're looking for a bounce, you have to say, is the risk worth the potential reward? And we look at that by looking at shorter term time frames, which for some reason my charts aren't pulling up here. Here we go. So we're at a rising 5-day moving average. Now let's take a look at that on a 10-minute time frame. This week we saw the volume weighted average price. So since that gap higher on Tuesday, again, it was a holiday shortened week, the average price was right here. Now, look at the action of the last 2 days, lower highs and lower lows. So we don't want to buy the pullback. Instead, we want to wait for, maybe breaking back above $97 a share with a stop underneath this level. If it's to do that, then perhaps it could run to the 50-day moving average up here, and that 50-day moving average is also at this prior area of resistance near about 101.5. So it all comes down to risk reward. What's your time frame? That's going to do it for me today. Hope you had a good week, and we'll do this again next week. Enjoy your weekend. Thanks.